Nice three-day bounce. Looks like it's going to be a four-day bounce. What's key from here to decide whether that'll be sustained through the rest of the year?
Yeah, we have to look at the context of actually the entire year. In January, we had a global blow-off top, literally, with all global US indices, Asia, Europe, all making new all-time highs. And then we had this initial correction in February. And something very interesting happened here, and that is we had a big divergence between emerging markets, China, Europe, and the US kind of went on its own track, making new highs while the rest of the world started correcting. And there was this illusion on the side of investors, well, the US is kind of an island in the sun, the earth is flat, nothing else matters. And then we had the big wake-up call in October. And why? And this is really, from a context perspective, really interesting. All these new highs that were made in September and early October for the Dow came on waning participation, weak internals, and a narrowing of leadership in some very high cap tech stocks. This is your classic market topping sign. We've seen this before in 2007, we've seen it in 2000. And then the counter rally that happened after that initial drop off, which we just saw in October, that was then the key moment where the markets actually make a lower high or whether they are able to make the new highs. And that's specifically what we're watching here now.
So what does that mean from today for the next couple of trading days? We have to go past the October, September highs again or not?
Ultimately, that's what needs to happen. It's either new highs or we're entering a bear market into 2019. That's the way the charts look at the moment. We had this rally that just came this week, was perfectly timed. We talked about it last week. There was a lot of oversold readings. These oversold readings are pervasive because this sell-off in October was actually dramatic. We had over $8 trillion in global market cap wiped off. And now these oversold readings are working themselves off. We're getting back into some key moving averages reconnect.
And if we look at the fundamentals, what would make you concerned that we are likely to head to that bearish outcome that you outlined? Would it be growth in the US or what?
Well, we're already seeing growth slowing down markedly in Europe. And obviously we've seen it in China, Japan, and South Korea. The U.S. is still on its positive trajectory from the tax cuts, but the question is how much further this can go on. There's, from every projection I see, and in the internals of the economic projections, we're actually not seeing a sustained new growth coming into 2019 from these tax cuts. So if they cannot accelerate in growth, then we're seeing slowing growth in 2019. And that will also impact earnings because we have very favorable comparisons 2018, but negative into 2019.
You mentioned earlier, of course, the fact that for most of 2018, US and international markets decoupled. We did see a pullback in the US in October, but of similar size to what happened around the rest of the world. So where does that leave us in terms of sort of valuations and preferences between US equities, rest of world equities?
Well, this correction now has realigned some of the excess that we've had in the valuation scheme. However, now what we need to say is if the market is not only depending on buybacks, because remember, what happened in October was all of a sudden a complete lack of liquidity coming in, because buybacks had a blackout window in terms of earnings. Now they're coming back. And so they can give you a positive boost into the rest of the year, rather. And we can also have frankly, positive seasonality. Maybe the China trade war is being resolved positively. And then, of course, the big question about the Fed that everybody's raising, and they're asking them to stop raising rates.